Hello guys, welcome back into the channel. Please make sure that you like the video and subscribe to the channel if you haven't already. And just also make sure that you are engaging us in the comments, whether you want us to look at a specific question or you have anything else to say, maybe about some of the things that we have covered in this video. And a special shout out to all our members. Just remember, guys, that you can join the membership of this channel and you will get exclusive NBT content that is available only to members. And yes, and there's lots more content that is coming in that is going to be available for our members in accounting, in maths, as well as many other subjects. So just make sure then that you join the membership for a small price of 149 per month, and then you can be part of the family. Anyways, without further more to do, let's get straight into today's question. Next question is 1.3, which says that we need to complete the statement of financial position as at the 28th of February 2023. So here's our answer sheet. Let's go to that answer sheet. You'll see there's those gray areas where we don't need to put any sort of number there because it's just not considered. And then the rest of the white areas, we can then fill in some information. So we're going to be working off this document here within Excel. So yeah, let's get straight into it. So we want to firstly find our investment because fixed assets and total of non-current assets is not relevant. So we're going to start then with working out the investment in the fixed deposit. So let's see then if we can find some information relating to that. Firstly, we can see that we're given fixed deposits of 1.5 million. Let's see if we have any information maybe that suggests that some of the investment is going to be maturing in less than a period of 12 months, and in which case we can then say that would be a current portion of the fixed deposit. Okay, so let's look at the information then. So if you look at information number 8, VIII, it says the company has invested in three fixed deposits of equal value. One of the fixed deposits will mature on 31 May 2023. Okay, so bit straightforward. So in this case, then, if we have 1.5 million in fixed deposit, it means that each deposit is basically 500,000. And one of those deposits is going to be maturing in less than a year because we are in 28 February 2023, but this one is maturing in 31 May 2023. And so what we can then do in that case, we're going to say, well, our investment in the fixed deposit, well, we're going to say 1.5 million, and then we're going to subtract 500,000. And so that gives us 1 million in respect of the fixed deposits. All right, then moving on to current assets. So the first current asset we do is our inventory. Now remember, for the inventory, we already worked out the closing stock. And then the other thing to look out for is maybe if we have any consumable stores on hand, like stationery, packing materials, and stuff like that. Let's see the company in amount of tax, dividends, debt equity ratio. And let's see if we have any consumable stores. So there's no consumable stores. So the only thing then in the closing stock, in the inventory, would be the closing stock of trading stock, which we worked out in the previous question, question 1.1. So 1.1 gives us 2,094,180. And it's important that we use this number because even if you had gotten this 1.1 wrong, but the fact that you know that you would need to use this when doing your statement of financial position, then you would get that mark. Then secondly, we want to look at trade and other receivables. So trade and other receivables, well, we're going to look at our debtors and then we subtract provision for bad debts. And then we look at our prepaid expenses, accrued incomes, and perhaps even SARS income tax if it is relevant for this. Okay, so let's have a look then. So the first thing that you're going to be looking for is the debtors control. So the debtors control is given as 483,110. Okay, so 483,110. So let's open that bracket, 483. 110. So in this then, we don't have a provision for bad debts given in the list of balances here, so that's not going to matter. And then we're going to look at each of these transactions quickly, but individually. So the first, the business uses a markup. This doesn't affect our debtors. This is for calculating closing stock. Commission income is owed to the business. So if it is still owed to the business, that means we have an accrued income in this case. So we can add the 41,000 into our trade and other receivables because that 41,000 is still receivable. Okay, fee income. So fee income, we already did discuss that the fee income is going to be an accrued expense because it is still yet to be received. All right, and then we move on to Bushel Limited. There's the square meters and stuff like that. So now in this case, we can see that there is a prepaid expense because as you can see that rent has been paid until 30th of April 2023, and we know that March and April will lie outside of this financial year. And then let's remember how we calculate the rental per month. Well, if you remember the way in which you calculated the rental per month, if you look at the previous video, we had worked it out to be 57,750. But to just work it out again so that you understand, let's do it here. So we're going to say plus, and then in that plus, one of the things that we're going to do then is that we're going to say, well, we have 175 square meters that we're renting, and then we're going to multiply by the amount that we're renting for, which is 330, and then it's 2 months that we want to, that we prepaid for in the current year because we prepaid for March and April. So then we're going to multiply by 2. Okay, so there is that. And then let's see if there's something else we need to look at. We've identified the prepaid expense. Then the next is the directors, but remember with directors, they are still payable, so that makes it a liability. And then next is transfer the debit balance of 2,700 from the debtors ledger to his account in the creditor's ledger. So this person has a debit balance. So if you're transferring a debit balance, well, you would credit, and so crediting debtors means subtracting from debtors. So that's how you transfer a debit balance, by crediting. If they say transfer a credit balance, then that would mean that we basically would debit if you transfer it. So in this case, we are crediting. So if you are crediting, then you are reducing debtors because debtors is an asset, and asset, when you credit them, you basically are subtracting them. Okay, let's see if there's anything else that needs to be considered. The company is invested in a fixed deposit. There's the income tax, an amount for tax is still owed to SARS. So if it is still owed to SARS, then it cannot be a receivable, and that would pretty much be it then for trade and other receivables after taking into account all the information that has been given. So that works out to 636,910. Then we move to our cash and cash equivalents. So cash and cash equivalents. So for cash and cash equivalents, well, let's see what we're given. So we're going to start firstly look for bank. So it says we have bank here, favorable, and then we'd look for things like, petty cash, cash float, which are not in the list. But then the other thing that is important for us to look at is basically the fixed deposit maturing in less than a year. So we're basically going to take the bank balance of 629,000, and then on top of that, you're going to add the 500,000, which is in respect of the fixed deposit that is maturing. And then other things to consider that are not here, but it's important that you know them, is things like petty cash and cash float or savings account. All right, so there we have our cash and cash equivalents. So that's going to be 1,129,000. And in this case, we can total our current assets then. So the total of our current assets is 3.8 million, 60,090. All right, cool. And then total assets, that's also gray. So we're going to skip there. All right, cool. Non-current liabilities were given. So the total would basically be that. And then we're also given the current portion of the loan. Now, the next thing that we need to try and work out is the retained income. So for the retained income, now we need to figure out how to work out the retained income. So we're not given, with the retained income, normally you go with the balance at the beginning plus profit minus the repurchase, above the issue price, and then subtract the dividends. But we don't have a lot of that information because we simply have a question mark, so we don't know which one to start with. But there is information that has been given here, and I want you to basically go and look at the last information, number 11. It says the debt to equity ratio for 2023 is 0.2 is to 1. So, in other words, you have debt on one side, you have equity on the other side. So, 1 in equity, 0.2 in debt. So, the way in which you can calculate this, then you can just simply say 1 divided by 0.2 and then multiply by the amount of debt. Now, the amount of debt is given because we do have debt here, which is our equity. So the way then that we're going to be doing that is we're going to say that it is 4,512,000. Then we're going to multiply by 1 divided by 0.2. So then our debt to equity ratio works out to sorry, I said 451,000 instead of 451, 4,512,550, right? Times 1 divided by 0.2. So then that gives us 22,562,750. And therefore, the difference between that will be between that total and ordinary share capital, which is then going to give us our retained income, which is 2,562,750. All right, cool. Then next, you can see that we have everything. So the next thing then to look at would be the trade and other payables. So trade and other payables always just start with your creditors control, and then we look at the transactions. So creditors control is 523, 890. So 523, 890. And then let's look at the transactions. Again, I would pretty much try to go one at a time. So we can see here that there's no creditors here, no creditors here. Commission, we know that was accrued income, but fee income, there was an accrued expense here because the fee income, not an accrued income actually, but an income received in advance because we received some of the fee income in advance. So we did work it out when we were doing the income statement. So if you don't know how to work that out, you can just watch the previous video. I'll just make sure I link it in the description. We did work it out. Let's look at our fee income. We worked it out to be 24,150. So that's going to add to our it's going to add to our trade and other receivables. Okay, now let's look at the other things then that may have affected trade and other receivables. Well, now we need to also remember that we had a case where let's actually go through one at a time. So prepaid expense, that was going to our trade and other receivables. And then this one, it says provide for the directed fees owed. So again, this is an accrued expense because the directors still need to be paid. And in terms of the calculation, we can simply go back to our income statement and remember that we had to add 75,000 and 10,000 for the amount that was owed to one of the directors. So that would be 75,000 plus 10,000. So we can simply just add 85,000. If you need to know how we worked out that amount, please just watch the previous video. All right, cool. So we got that. And then what else do we need to look at? We need to look at the case of transferring the debtors. So we're transferring the debtors balance of 2,700 from the debtors ledger to the creditors ledger. So as I said that when you are transferring a debit balance, you would credit the debtors, which means then that we would debit the creditors. So if you debit creditors, creditors decrease on the debit, and so we would subtract these creditors with 2,700. Okay, cool. So that would be about it, and then the rest is on the taxes and the dividends. All right, cool. So then the next thing that you're going to look at, we already look at the current portion of a loan, but now we're going to look at dividends. So let's look at shareholders for dividends, and then we'll come back to the tax after. So shareholders for dividends, how do we work this out? Well, let's see if we can be able to find our final dividend. So you can see here that we're given a dividend on ordinary shares of 990,000. And then if we look at the information given here, it says that we have interim dividends paid 990,000, but we have final dividends due of 2,640,000. That needs no calculation. Fairly straightforward that our shareholders for dividends is 2,640,000. And then lastly, we have an amount of tax is still owed to SARS on 28th February 2022. Well, in order to basically figure out how much is SARS income tax, we would need to look at, well, how much did we pay in terms of provisional amounts in provisional taxes versus the tax for the year. Now, the tax for the year, remember that it is in our income statement, it was already pre-filled. So our income tax for the year is 1,152,000, but we would have made provisional payments, as you can see that we made provisional payments of 1,049,000. So then we can see that we basically paid less tax than what we were charged. And so to work out the SARS income tax, we will take the 1,152,000, which is the income tax. Okay, so let's go here. SARS income tax. So the SARS income tax, well, the SARS income tax basically then is going to be 1,152,000 minus the amount paid in provisional payments, which is 1,049,000. All right, and therefore, what do we get there as the SARS income tax? We get our SARS income tax is 103,000, and again, we can total our current liabilities. So if we total up our current liabilities, this gives us 3,793,340, and that basically concludes question one of the November 2023 paper. And yeah, and that's pretty much it then. I will see you guys in the next video, and don't forget to subscribe. Cheers.